Hello, this is David Moore with Equity Advantage, 1031exchange.com, and today's question is, what is a 1031 real estate exchange? And I guess just got to clarify, 1031's been around since the 20s, and historically we were able to handle exchanges of personal property and real property. Tax reform, when it came to be, it eliminated our ability to handle personal property transactions. So you used to do cars and boats and planes and all kinds of fun stuff, and we've lost our ability to do those things. So today, any 1031 exchange is a real property exchange or real estate exchange. So when we look at the process, historically people look at an exchange and think in the context of you've got something, I've got something, we swap properties. The problem with that is you've got to actually find things, people with assets that match up value and equity wise. You've got what I want, I've got what you want, and we can do a swap. Well, that sort of evolved into what's called a three-way exchange or an accommodated exchange, where you're using an intermediary, an accommodator, a facilitator that's paid a fee to step into the middle of your sale and your purchase, and we convert it into an exchange. So as far as the taxpayer is concerned, you're selling property, you're going out to buy new property. It's the accommodator's job to create an exchange out of that event. And when we're talking about it in broad terms, I like four basic parameters. One, it's got to be an exchange. You give us something, we give you something back. What's given and received have to be of like kind. Like kind refers to the nature of the investment rather than the form. Three, we've got to satisfy what we call the napkin test. And that says that you go across or up in value and equity. A lot of misunderstanding out there on that one. A lot of times you're going to hear people say you have to replace debt in an exchange. Totally untrue. Debt can go away two ways. One, by going down in value, which triggers tax because you went down in value. The other way debt will go away is by adding funds to the transaction, which is always fine. So when we have like recessionary times, the loan to values change, maybe equities change. We've had people come to us and say, hey, I don't want any debt on the replacement property. Do I need to pay off the relinquished property in advance? You don't have to do that. You can always add money to that replacement property. So once again, value and equity, that's what's critical. And if you don't fully meet the exchange requirements, you're just going to pay tax on the difference. It's not all or nothing, so you don't sweat that. Every dollar more you spend on something than you want costs you $1. If you don't spend it, maybe it's 30, 40 cents in tax. Finally, we've got to have continuity of vesting, and that just means that the taxpayer that relinquishes receives. So the person or entity that gives us something, we have to give that person or entity something back. Sounds easy enough. Very complicated because the finance world so often doesn't see eye to eye with the tax and legal world. And if you look at that concept, continuity vesting, it's the second biggest headache we've got in the exchange business, only to time. So to summarize, 1031's been around since the 20s. It's a great tool. We'd say it's one of the most important tools in your portfolio to make things happen and keep your money yours. It's a tremendous wealth building tool. It's very inexpensive to use, and it can allow you to accomplish all kinds of things. So anytime you're contemplating a sale of a piece of investment real estate, if you got questions or concerns, please don't hesitate to give us a call. We'll do what we can to help you out, and I hope that's answered the question. Take care. Once again, David Moore, Equity Advantage, 1031exchange.com. Thank you.